I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. The global wholesale and specialty insurance and reinsurance segment of the market has been putting out very strong results in recent times. If I had to highlight a consistent theme in my interviews of the past year, it would be an almost universal desire among carriers for continued growth, but without compromising on profitability, as appetites return and the market becomes more competitive. Today's guest is a senior underwriter who embodies that conundrum. Andrew McMellin is President of Markel International, a business that has done extremely well in the past few years and which has set itself ambitious growth targets for the next. This podcast examines the delicate balance that allows growth to continue to flow down to the bottom line and not just add volume on the top. Andrew has had a long and successful career, and his insight and long-term perspective is extremely valuable. In this podcast, we examine Markel International's growth strategy in detail, and on our way, evaluate all the concurrent phenomena impacting the market, such as digitization and the streamlining of follow capacity, as well as the impact of AI and a more collaborative reinsurance market. Andrew is on exceptional form, and this is a very enjoyable encounter with a market player on the top of his game and looking to maximise the opportunities that a still healthy insurance market is affording. Enjoy the podcast. Andrew, welcome to the Voice of Insurance.
Mark, it's a pleasure to be here, and thanks for the opportunity to speak to you.
It's really, really good to catch up with you. It's been quite a long time. I've known you quite well over the years, but for anyone who's listening who doesn't know you, could you give us a quick run through of your career to date, how you got into insurance, and then obviously how you ended up where you are now?
Sure, Mark. Very happy to. Actually, it'll be 38 years this September, actually, when I started in insurance. Graduated with a geology degree, but at a time when the oil and gas industry was going through a bit of a down period, and so looked at other opportunities. And you may remember back in the late 80s,
because the oil price was really low then, wasn't it?
Yes, and the city had gone through that big bang. Digitization of the stock market, which is interesting when you think about what we're trying to do with the insurance market 40 years almost down the line. So graduated from university, joined what is now Willis as predominantly a casualty broker, broking in around the London and Lloyd's market, and did that for 7 glorious years before then deciding I wanted to go onto the underwriting side and joined what is now Amlin, underwriting UK international casualty business.
And which bit of Amlin was it? Because I always think of Murray Lawrence.
It was Murray Lawrence.
ML
so I joined at Murray Lawrence, which then merged with Angerstein at the time to then form
Was
Amlin.
anything the in? Remember, so Angerstein was the A in Amlin, and Murray Lawrence was the ML in Amlin.
Yeah, what was the in? I don't think there was an in.
No, it just needed something.
No,
couldn't just be called AML.
But now, of course, it's like a lot of these things, and it's all merged and now become MS Amlin, of course. Did that for about 5 years and then joined Catlin to start a new casualty account for them and spent 17 years actually at Catlin and Excel Catlin doing various underwriting management roles, became deputy active underwriter of the syndicate, became deputy group chief underwriting officer, had a period working and running their US business. So went out with the family to live in the US for about 3 years. And then came back to the UK to run Excel Catlins, because Excel then had purchased Catlin, run their UK and Ireland operation before departing in 2017. I then had a little bit of a period out, doing a bit of consultancy and reacquainting myself with my family after quite a period of time of travel, and then joined Pioneer to run Pioneer, which was a London market MGA, had a couple of overseas operations, and was there 2 years and actually sold it to what has now become K2 International. Before then joining Markel just over 3.5 years ago, and joined Markel to run their wholesale business, which is their London market and Asia Pacific business, and then became president of the International about 2 months ago.
Well, congratulations.
Thank you.
Well, it sounds like you got reacquainted with your family, and now you're running another global business. So does that mean you're going to be accumulating lots of air miles? Run us through the geographic breadth and the scope of what Markel International is within that Markel group. It's a very large business.
Yeah, so the international business is part of the Markel Insurance business, which is now run by Simon Wilson, the CEO, who was my predecessor here at International. And the international business is everything outside the US and Bermuda. And it's a $2.5 billion premium operation. We split it into two divisions, a wholesale division, which is what I was running and still continue to run. Actually, was our London market Asia Pacific business. And then we have what we call our national markets division, which is our business in Canada, the UK regions, and then throughout Europe as well. So yeah, quite a large business these days. We've grown it over the last 5 or 6 years from about $1 billion in 2019 to $2.5 billion last year. And more importantly, improved the combined ratio from 99% in 2019 to a sub 80 combined last year. So very pleased with the momentum and growth, but the profitable growth that we've achieved over that period.
So your job's to carry that on. How are you going to do it?
Yeah, so continuing that momentum, and actually our vision for the next 5 years, we talk about putting Markel on the map. And that's really thinking about how do we then continue that growth? Because whilst we've had great growth over the last 5 or 6 years, when we look at our market share across many of our regions, we're about 2% here in London, and that's done really well, and we'd like to see how we can grow that profitably. But everywhere else, we're probably still sub 1%. So when we think about Canada, UK regions, Asia Pac, Europe, and so we've got a lot of headroom, we think, in terms of how we can grow the business profitably. And putting Markel on the map is really thinking about how we're going to take that $2.5 billion we did at the end of last year and grow that to a $5 billion operation by 2030. But importantly, do that at a 90 or sub 90 combined ratio. And the profit is the key rather than the premium.
Anyone can grow unsustainably, but then, of course, they can't sustain that because you can't keep doubling your losses every year. In terms of geographies, I think it's very clear. But in terms of classes, I would now associate Markel with writing virtually everything that I can think of. Are there any new adjacent classes you could get into, for example, that would help you with that growth?
When we think about our London business, we have quite a breadth of product within London. We think about that in sort of three main product divisions. We've got our professional, financial and cyber business. We have our marine energy business. And then we have our specialty business, which includes our casualty, our trade credit, equine. Probably the main area when you look across our product shelf here in London that we're not really too involved in is commercial property. We write technical property, so our energy business, our marine business. But general commercial property is probably one area that we have as a gap. And that's something we've been exploring and researching as to whether we want to get back into that. When we go and look at our regional business, we've been building our product shelf in Asia Pacific over the last 5 or 6 years, but we still have quite a narrow product shelf within our UK business and our Canadian and European business. And to us, the opportunity and the feeling and the theory behind putting Markel on the map is how do we increase our relevance in those markets by bringing more product to be able to talk to our brokers and our clients with a wider product shelf. And we think that's what will give us the opportunity to grow profitably over the next 5 years.
Because, of course, probably within the Markel Group, somewhere in the world, you probably write almost everything. But you have to be able to bring that to that local space and be able to service it.
Yeah, and one of the pillars underpinning our vision is what we call Best of Markel, and that's thinking about that product expertise that we have, not just in international, but it could be in the US as well. And so we've got some very specialty businesses in the US and thinking about that product expertise and aligning it with our distribution capability and expertise that we have, as well as the investments we make in technology. And how do we then bring that together to actually then develop more products and take more products out to our brokers and our clients?
So do you think are the best opportunities in that strategy of bringing more classes, bringing more products to different places? Or are there any territories that in general are just going really well, in which case you can grow sort of much more organically?
Our plans are very much built on organic, and we see great opportunity because of the position that we're in and the momentum we've carried through the last 5 years to be able to continue that forward over the next 5 years. We will look at inorganic growth. You'll know that we just closed on MECO at the end of May. That's a specialist marine liability and P&I MGA, much like ourselves, a family-run business, been going 50 years. Based out of London, Dubai and Shanghai, and fits very nicely into our marine capability that we already have. And we see some real complementary elements that can take that business forward. So there's an element of organic, and we'll continue to look at inorganic growth as well, that we can then deliver and bring more capability out into the market.
So we should watch this space. Lots of things going on. You're going to be very busy, Andrew, it sounds.
Very much so, yeah, very busy, but still thinking about our ethos of being a people-led business. And that's the other pillar that we think that underpins our putting Markel on a map is how do we continue to cultivate a people-led business, attract talent so they can come to Markel, create a business, and we're very entrepreneurial and want to give people the empowerment to create that business and create their career journey here at Markel and retain them through their career. And we've got some long tenured individuals that have been helping us with that journey over the last 5-10 years. And we look to continue to attract and retain those talent as we go forward.
Obviously, you're building out and deepening the places where you already are. Are there places where you're not yet that you hope to be in 5 years' time, for example?
A lot of what we're doing in putting Markel on the map is about how to increase our relevance where we're already situated. But you'll know we set up in Australia just coming up for 2 years ago, and that's been working really well under Rory Morrison's leadership. When I look at Europe, we really grew Switzerland over the last couple of years. And again, France is an area we've been in, a smaller part of the business, which we're looking to grow. There will be other geographies, I've no doubt, the next 5 years that we'll want to grow into. But a large part of the strategy is how do we build in the regions and the geographies we're in the moment as well. So there'll be a bit of building within existing geographies as well as thinking about what other new geographies we might see over the next 5 years.
Just surveying the world, obviously, being able to bring that combined ratio down, let's say, because we've had a very strong market, we've had plenty of rate over the last 5 years. Now we're looking to see rate coming off a little bit. How happy are you with, obviously no underwriters are going to be that happy with rate coming off, but are we still in a pretty rate adequate sort of green light for growth type environment? Or is that still...
Absolutely. I think we are still seeing good rate adequacy. Yeah, clearly there are some elements of the market that we're seeing more pressure on rate, and that's probably not a surprise because we're not the only ones that have produced good numbers, to your point. And generally, when you produce good numbers, management teams then say, well, how do you produce more? And that creates more supply within a market, and that creates that competitive environment. But we're very focused on what's the rate adequacy. And when we look across our portfolios and also align that with our relative size in these markets is where we think we have plenty of headroom. That's why as we bring new product into market, we think we've got that room to continue that profitable growth phase. But the profit is the key. And whilst we have these ambitions to double the size of the premium business, it's not at the expense of the profit. At the end of the day, we're not as wedded to the top line. We're much more wedded to the bottom line. And that's what will guide us through the next 5 years.
So if it becomes less and less adequate, then head office is always going to be, well, they won't be happy. But if you're reporting back and say, well, look, we just can't hit these numbers, we're going to have to revise all this now because the market's changed, then I suppose that's going to be the way it is. And market's been around long enough.
And to be fair, that's the way the underwriters think. And we've been investing in our portfolio analytics team. And as part of that is actually investing in those portfolio managers to help the underwriters understand their segmentation within their portfolios, understand where they're sort of seeing outperformance, where there are areas that they need to remediate. And the underwriters have been very key in terms of understanding how that feels and moves through that market cycle. Whilst, yes, we as management will keep an eye on the numbers, the underwriters have the tools and the incentivization to do that themselves.
If you give an underwriter better tools to fully understand their portfolio, of course, they're going to jump at the chance. I mean, a good underwriter, obviously, a poor one would probably rather keep their head in the sand, but good ones, always, the more tools you give them, the more they're going to use them, the happier they're going to be. And I suppose even in a really good market, there's always a segment of the portfolio that needs remediation, isn't there?
I mean, portfolios are dynamic, absolutely. And so you're always at any point of the market going to have areas that, you're outperforming, areas that might be underperforming. I think one of the keys that we've seen and one of the successes, I think, in terms of our investment around portfolio analytics is the culture and the way that the portfolio managers are embedded and work with the teams. What I find really pleasing is the way the underwriters keep coming back and asking for more. How can we spend more time with our portfolio managers? How can they do this for us? How can we understand this part of the element? So we're not actually having to push anything to the underwriters. They're pulling from us, which I think goes to the heart of the culture and the entrepreneurialism and the business builders that we have here at Markel.
Yes, because I was reading something on the website about, certainly a big thing, probably in the annual report, about empowering executives. Is that really, when you talk about this, particularly for an underwriter, the portfolio management, that day-to-day portfolio management, knowing if you're putting a line down at these terms and conditions, at this price, that you should be happy with yourself. You said, theoretically, I'm putting something on the books that is going to be making a profit and being accretive to my portfolio. Is that how it's manifesting itself for people on the ground?
Yeah, I think there's 2 points there. One, that local empowerment is really important. And having that empowerment of leadership, again, is one of our pillars underpinning putting Markel on the map. And we really do believe, and the people that are in those geographies, in those markets, understand those markets better than we do at the centre. And the more authority and make them more accountable and responsibility they get, the better they behave. And that's the way that's actually been a hallmark of our success over the last 5 years. And that's why we continue to push that. But it's not just underwriters. One of the areas that we have been initiating over the last few months is within our support areas as well, that back up the underwriters. And bringing them closer to the decision makers. So we've been decentralizing a lot of our group shared service elements, pushing that into the likes of international, into our US business, because again, giving our management teams within international the authority to understand how they're going to invest, whether it be in IT, whether it be in operations, means that we think we'll get better results and we'll actually be able to grow the business at a more efficient expense ratio than in the past.
But with all that, I suppose you have to have those controls to avoid rogue elements, etc. How do you balance those two things? Say, I really want you to crack on and do this yourself, because I certainly don't want to micromanage you from London, just want to talk to you every now and again. But how do you then sort of trust and verify, I suppose?
I mean, it's partly in terms of their planning and coming up with sensible plans that we hold people to account to, and then having touch points with them throughout the year. So you understand how the portfolios are moving, what's happening to rate adequacy, what's happening to claims. So like any business, yes, we have local empowerment, but you always have reporting and touch points where you can understand and see how the business is operating.
So I
that's
suppose
really important.
If you can see in near real time what's going on, then you all know what you're talking about. And you can say, well, what about this thing you did yesterday? Not sure about that.
The data analytics and the data dashboards we provide to both the underwriters and management see that as well. So they, at the same time as the underwriters, can see what's happening on a daily basis and a weekly basis, what's happening to those portfolios. And then, like a lot of companies, will have quarterly claims and reserving meetings, which then bring another touch point in terms of how the performance of the business is going.
One thing, obviously, we're in a slightly more competitive market environment. You're in the wholesale space. There is a dynamic that happens when more competition enters the insurance market, that submission flows change in terms of what we see. Obviously, we see in the US market. In a harder market, you see a flow from admitted into excess and surplus lines. And generally, when a market has more capacity, then it's less likely to use the wholesale market, or certainly the excess portion of that market, if they can write bigger lines closer to the risk. Are the submission flows still stacking up? Are they still coming in the same sort of volume?
So submission flows in London, are holding up. And in fact, we've seen them increasing, and particularly with a lot of the geopolitical uncertainty around the world. I mean, we shouldn't underestimate the impact that's having on our clients. And we, within insurance, can help provide certainty to them, whether that be on the trade credit side because of tariff environments we're seeing coming out of the US administration, whether it be from various conflicts going on around the world. That's clearly brought submission flow into a wholesale market like London, which can provide complex solutions to those risks. The other element of it, and one of the strategies that we are employing as we go forward over the next 5 years, is how do we balance our London business, which tends to be more complex, more volatile in a more volatile wholesale market, with our non-London business, where we are closer to the retail broker, closer to the client. The business tends to be less complex and so less volatile, and there's less movement in that marketplace. Now, at the moment, I mean, our London business is about 60% of our international business. Our ambition over the next 5 years is to make that more 50-50. London, we're still seeing plenty of opportunity, and our London underwriters are not going to stop and wait for our non-London colleagues to catch up. And so it does put more emphasis on how do we grow our non-London business, and we've been implanting growth plans within those areas. And as I mentioned earlier, as we think about how do we get more product out to our clients and our brokers, that will help us grow that non-London business.
Would it be fair to say, in general, the direct national business is slightly higher expense, but it's less volatile?
Our national markets business does tend to have a higher expense associated with it. It is less volatile. At the moment, a lot of our emphasis within our national markets teams is more around the SME side, but we see opportunity within mid-market, and particularly taking more product out into those operations that allows us to get more into that mid-market business. But yeah, it's a less complex, it's more vanilla. It doesn't tend to have the same sort of volatility of claims that we see with the more complex business in London. And we as a business like the balance between that London complex business with the non-London business. And if we can get that to a more 50-50 element, that provides a more resilient and consistent profitability that we can produce as a carrier.
You buy reinsurance. Reinsurance has had its own cycles. Obviously, it moves in its own world. It's all connected. It's a different limb of the insurance body. What would be your expectations coming into the renewal season, second half of the year, when we go into Monte Carlo and these sort of places and talking about renewals? Presumably, you'd be expecting slightly more competitive terms?
I think we would expect more competitive terms, and we're cautiously optimistic. We've seen, certainly at the beginning of the year, better terms than we had in previous years and better alignment. So we didn't have, you've seen some programs in the market where they're a bit of a patchwork quilt, people more aligned to understanding that they need to provide their clients with a consistent product. We're seeing more opportunities and options in some of the lines like cyber, for instance, which is developing and maturing as a reinsurance product. But I think we're cautiously optimistic. There are certain elements of the market, US casualty, where I think the reinsurance market is still catching up with some of the dynamics we see in that market. Not that we're particularly big in that field. And a lot of it will depend on nat cat activity and even man-made activity as what will happen.
You say there's a greater consensus. Sometimes the insurance market is very bullish about something and reinsurers are all very cautious about it, and sometimes vice versa. Do you think everyone's more aligned in terms of their view of risk at the moment?
I think there is definitely more alignment there, but I think reinsurers need to make money over the cycle as well as insurers. But I think there's a realization that they need to provide a holistic product to their clients. And I think one of the areas of disconnect we saw when we go back 2 or 3 years ago was we weren't seeing that alignment of product. And that wasn't making reinsurance as attractive, perhaps, to the likes of buyers like ourselves. And we're seeing that better alignment going forward, which I think is important.
Yes, certainly. I get that. Reinsurers these days, they're much more in that mode of they want to partner with people like you.
We think of reinsurance as a capital. We'll take healthy retentions because of our balance sheet, but recognize we want to have relationships with our reinsurers over the long term. And we have some very strong relationships that have seen us through thick and thin and through different market cycles.
Well, that's just the sort of reinsurer you want, isn't it? That's the promise of reinsurance generally, that they're going to be there through thick and thin. It's only when you have a bit of a crunch time in the market that sometimes those relationships have to get reset and remade and you have to make new friends. Yeah,
but it's important to have those relationships, and they provide certainty to us as a reinsurance buyer, just as we provide certainty to the end client from our products as well.
You're on a growth mission. I mean, one of the greatest ways, of course, of ensuring growth is to grab a tiger by the tail, as they would say. Find a fantastic, a new, exciting growth class. If we'd been sitting here 15 years ago, we might not have yet identified that class as being cyber 15 years ago. But of course, if you had grabbed that class with both hands, that would have helped power quite a lot of your growth. Do you think there are similar classes? We've got a lot of interest, it's a lot of innovations going on in the marketplace, and it's quite an exciting time. Out of all those interesting new potential lines, are any that you've identified you think, I think this could really be the next cyber, for example?
Well, I think the obvious one probably that a lot of people think about is in that renewable space and the energy transition. And clearly there's a huge amount of investment going into that world across the globe. You're talking about investments last year, about over $700 billion of investment within the renewable space. And so clearly insurance has a really important part to play with that. It's also still a new and evolving area. Seeing wind turbines get bigger and bigger and bigger, and that creates more stress on the product and on the insurance product as well. And so we and the rest of the market has to take some caution and understand what does that technology mean to insurance, because we're there to provide insurance product. We're not necessarily an equity part of that. But also, when we think about the likes of battery energy storage, which is an area that we've been investigating heavily to enable the fact that actually solar and wind is not completely dependent. You'll have quiet wind days, you'll have quiet cloudy days, and the investment in battery energy storage has got to be important to actually sustain the renewable space. And again, we're seeing some really big investments going on in there. I mean, I think the investments in 2024 were double what they were in 2023 in that area, but it's still a long way to go. And I think we have to get up into the terawatts of capability. We're talking about up to 5 terawatt capability by 2050 to be able to actually cope with that sort of net zero element. So that's an area that we see and are making investments in.
That's a fairly new risk because no one's built batteries that big before.
No, to the point of the technology risk and issue, and understanding that is really important.
Wind turbines, solar panels are far less of an unknown quantity these days, though, would you say, from an underwriting perspective?
They are, but then there's also, in terms of the investment, is how do you cope with if incomes are low because they can't generate enough because it's a cloudy day from a solar standpoint. And so thinking about that income generation protection product, it could be a way, and certainly a way that we're investigating in terms of how we can bring a new innovative product into the market.
And the products around, for example, ensuring the efficacy of those solar panels over a 20-year period, which might be the sort of finance period, the mortgaging period that they've got with, with their bank, for example.
Very much so, and enabling that protection so they can go out and work with the banks to get the loans to support the investment. investment. And I think that's where insurance can bring, and that's what we're investigating, how we can bring product to help with that transaction.
You seeing commission levels creeping up now that the market's getting more competitive?
I think certainly in certain areas we're seeing pressure on commissions. Again, where the market really needs to focus on is how do we make the transaction more efficient? So rather than just go into the kind of fun and games of commissions go up, commissions go down, if we can make the transaction more efficient so everyone wins and we can actually deliver a more efficient product to the client at the end day, that's got to be important. And the client can win, the broker can get their return, the carriers can keep their return. That's the way I think the market needs to focus on. And I think we've still got some ways to go to be able to do that.
I suppose, yes, certainly in London, which has had to pay higher commissions to compensate the fact that it's probably harder to do business here, and you may, of course, need more hands to get it to London. Presumably, when we digitise, there'll be less justification for that. And of course, we can keep that submission flow up because we can be more competitive.
If everyone in the distribution value chain is actually creating and making their sort of returns, then everyone should be happy. Now, I think we have still some ways to go around that digitization. We're seeing with some of the fast follow facilities that we lead and take part in, they're still not end-to-end digitization. And I think that's what we need to work to, because that's when you really unlock the value that the client can get out of it, as well as the broker and the carrier as well. And there's still some ways to go there.
I'm sure the top 10 producing brokers here in London for you will have nearly all got, or if they haven't got it now, they'll certainly have it by the next couple of years, some sort of broker portfolio facility that they'll be asking you to write. Do you think that's going to change the dynamic of the marketplace at all? Or will it just be something that's incredibly efficient and useful?
I think it'll be efficient and useful, and it will change the dynamic as well. And I think we're already seeing that. And probably should also just take a step back. I mean, broker facilities have been around for quite some time.
Yeah, forever.
They're changing. And I think what we're seeing now is the sort of next iteration. And I think they are very much here to stay. We're very much involved in that, both on an individual class level as well as cross-class. We've invested in a structural portfolio solutions team to look at some of those cross-class deals. We've been at the forefront working with the likes of Marsh to help launch their Slipstream Marine fast follow facility. We lead that and actually help create them a market and working in partnership with them. And then we did something similar on the energy side called Pearl. And then we're also working with Willis on their undercover facility, which is their cargo political risk facility, which we've been working with them on that. So there's definitely more that can be done there. We want to be at the heart of doing that.
I wouldn't have associated you before with providing capacity to sort of fast follow, but more as investing in being the leader type underwriter. Or now would you be going for more of a hybrid?
What we're seeing in the marketplace, and we will continue to see, we will still need leaders. In most, if not all the lines of business we write here in London, we're in a leadership position. And that's important. And that's what you need to create the market effectively for the products that fast follow can then come alongside. And I think you're going to see that continue to evolve, and we're going to continue to invest in that. So we think we can do both, and we want to do both, and there'll be others in the market that'll do
different
likewise.
Skills, aren't they? But there's no reason why you shouldn't do both, and I suppose it's interesting diversification.
And there's also been leading the fast follow, because whilst they are fast follow facilities, they still need to manage the indexation. Because I think the key with all these facilities is how do we make them sustainable across time? And that's got to be a partnership between the broker and the carrier. Because if we're going to clients and saying, we've created this fast follow facility and you should give us some of your capacity to put under that, but if we don't make them sustainable, in 3, 4, 5 years' time, the broker's going to be at the client and say, oh, that facility's gone because it didn't make any money. And that's not going to help the clients, or it's not going to help the market. So I think there's a really important part for both broker and carrier to play together to make sure that these are sustainable across a longer period of time.
Yeah, particularly if they had quite a lot of investments to wrap them up in the first place. You don't think, oh, just now the market suddenly softened, everyone's going to come off it and go back to open market again.
And just think about the efficiencies that you'll lose if people do that. Because if you're there as the broker, if you can transact in a more efficient manner, that should mean that you've got a better revenue generation over time. And if you as a carrier can do likewise, so again, that has an impact and a positive impact to our expense ratio as well.
As we fully digitise, and one hopes that we will be, we can see that there will be a percentage of the market that will be in a sort of broker cross-portfolio facility. And there might be a class-specific one as well, additional to that. And then there'll also be some fast follow capacity following the open market leader.
And algo opportunities as well.
Trading and the other things. What percentage will be automatic and what percentage will be leaders and presumably second alternative leads and third
I think it'll depend class by class. I think it could be anything from 30 to 50%. I think the key is you're going to still need leaders. And of course, As a leader, you don't necessarily lead every single piece of business. So those leaders will follow capacity as well. And I think it'll depend on the complexity of the business and the complexity of the indexation of that business as well. It's hard to put a hard and fast number on it. I think it will vary. But clearly, it will be made up to the various different facilities and areas of the market you talk about.
Just to clarify, what do you mean by indexation of business? Turning into an algorithm?
So getting the indexation that, so you're getting that perfect portfolio effectively.
Right.
So if you're seeing the marine business from a particular broker, you're seeing all that marine business, which will be 100% indexation. You're not necessarily going to get that. But the higher percentage, the more sustainable and the more confident you can be in the performance of that business.
So you're getting that showing that in the old market, somebody might have thought they were a lead underwriter because they could only lead things they were shown. These days, of course, now if you participate in all the different facilities, you can say, well, even the ones I'm not shown, I'm still participating on them anyway, so I've got a far better diversification of my book.
Quite. And also recognising that how is the performance of the different classes of business that make up that portfolio, how are they performing over time? And that indexation, got to go back to how do you make them sustainable? So making sure your indexation is enabling that sustainability so that they can actually perform over a longer period of time and be there for the clients in 5 years' time is important.
Something else, a big secular trend that's been happening almost in parallel with the digitalization of the market. It's been the increase in the market share written by MGAs all over the place. Obviously, you've just acquired one. So what do you think is behind that? Ultimately, because of course it's been a growth that's been cross-cycle. You can't just say it's a soft market thing, because it's not. It's been through soft and hard markets now, and that share has been steadily increasing.
MGAs have been an important part of the London market for a long time. And if you look at the Lloyd's market, I think it's something like 40% of the business in the Lloyd's market is delegated to MGA.
Lloyd's, it is an agency and capital provision. The two are separate and always have been.
And it does go through ebbs and flows. I mean, when you saw the market harden, you did see MGA capacity reduce. I think what's been surprising to a lot of people is how resilient and how quick it's come back. And I think part of that is the agility in terms of how easier it is now to set up these businesses. They have less legacy, perhaps, in terms of systems. I think the key, though, from an MGA standpoint is what's the product differentiation or distribution differentiation that they bring for their carriers? And often or not, it's more distribution perhaps than product, but we know there are product specialty MGAs out there. And I think that's the key as you're a carrier thinking about who you're going to support is, how does that fit into your overall distribution strategy?
So you still expect your delegated to keep growing?
I think within a proportion of the business, it'll be around sort of the 40-45% mark. And some of it will ebb and flow depending on what we see as profitability. I think the key is the MGAs have got to make sure they continue with that alignment of interest so that they can continue to show their carriers that they're being profitable over time. Because we know from the past that if MGAs that don't provide profits to carriers don't survive. And that's got to be key for what they do going forward.
And of course, you've invested in all your portfolio analytics. You know exactly which MGAs are doing a good job for you and which ones aren't.
And we work with the MGAs to show them that insight as well. And that's the important part that we can bring to help those MGAs is help them understand their own portfolios and help them with their own tools. More of them are much more sophisticated than they were and so have invested heavily themselves in these tools. Others still need a bit of help from their carriers, and that's what we're here to do.
And we can be sitting anywhere in 2025 without talking about AI and what you're doing with it or what it's doing to you. Who knows? So far, everyone's been experimenting with AI in the last year. What have been the best use cases that you've found so far?
I think for us, AI, the best use case has been around data ingestion, how we can utilize huge, great data sets and interrogate them and work with them much quicker and more efficiently than we have in the past. One of the areas that we've been really successful on is we have this AI tool, which is in the legal world called Harvey. And that's helping our W&I book to ingest huge amounts of data and help us get to underwrite that business probably 3 times quicker than we were. And that enables us then to think about different segments of that market and explore segments in that market that we couldn't previously do because it wouldn't have been efficient to underwrite. And utilizing this tool means we can get after that and actually underwrite those segments a lot quicker and a lot easier than we have in the past.
So W&I is warranty
indemnity,
yeah, so these are the promises that companies make to each other when one is buying the other. And often there's things about the tax liabilities that they might be incurring, etc., when they do take something over, or the things I've promised this to you and therefore the insurer comes and backs that up. And of course, there's a huge amount of documentation to read through.
huge amount of documentation, which tends to, in the past, meant that only the larger deals are ones that have been of interest to underwriters. Utilizing AI means we can go down into smaller transactions, which opens and unlocks the ability, to give the clients a product they couldn't get before, but also for us gives us new distribution angles and to get in different markets.
It's one of those wonderful things where you could sell a company for £5 million, but if you spent 400,000 on a W&I product, you might be able to sell it for £6 million. But somehow we all managed to win. So it's where insurance leverage really, really works. Isn't it?
Yeah, it really helps the client and unlocks their ability to go and do more transactions.
Absolutely. Anything you can do to unlock more of these value-added things. So it's more about low-hanging fruit type stuff and freeing up the professionals to not have to waste their time sort of cleaning data and reading through reams of documentation and actually doing the deals that add the most value.
It is. The other area, interesting, that we're actually utilizing it in our European operation. So we're actually utilizing AI to scrape publicly available data, align that with products that we want to sell, and from that, being able to go out to new clients and new brokers and say, yeah, we're Markel, we believe we know what you do, here's a product we think is relevant to you, and here's the price for it. And that's where AI is not just going from helping you become more efficient, but it's actually driving new business flow into us. And that's something we've just launched about 3 months ago. So we're still very much in a pilot phase in Germany, but seeing some great success and getting great interest from our broker colleagues out there.
And so you're effectively marketing to the brokers and saying, well, this is what we're up to. These are our
we're going
appetites.
to brokers who perhaps haven't traded with us in the past and clients that certainly haven't traded with us and saying, yeah, we're Markel. This is an area of the business that we're interested in. This is your client. And here's a quote that you can then take to your client, utilizing information that we've got from utilizing AI.
Just all the public information.
Yeah.
That's absolutely amazing, isn't it? And certainly if you're out trying to produce business, this is a hell of a tool to have, isn't it? It beats cold calling people.
Fantastic tool and also be transferable across many geographies. So as we think about how we want to, and this comes into one of the pillars of putting Markel on the map, our operational excellence. If we want to increase our relevance in those marketplaces, here's another tool that can help us get more product and get us out to more clients and more brokers.
You're running effectively a global business. I mean, not quite every corner of the globe, obviously the US, no, but it's every other corner of the world. You're saying you're putting Markel on the map all over the globe. How do you make sure it's the same flavour of Markel everywhere?
Well, we have that, what we call the Markel style, which is really embodies our culture. And that's really what drives the ethos of the underlying business. And it's very much built around collaboration, teamwork, entrepreneurialism. You sort of see that when you go into any of our offices. But we allow people, and that's that local empowerment, to interpret, how they're going to apply that style within their region. And together we apply the vision of the business and putting Markel on the map that we have. Thinking about how we make that inclusive all the way through, we utilize our networks. But it's also how we tie people in together with big global town halls. We invest heavily in connecting people physically so they can spend time together, create the rapport, create the trust, and build that culture as we go through. And that's been a really important part of what we've done. And actually, it was that culture that attracted me to Markel. And as I was going through joining here 3.5 years ago, seeing that collaborative teamwork culture come from both people here in the UK, in the US, and there hasn't been a day go by where I don't see that in practice. And so we really do live and breathe that style, and that helps bind us all together as we want to put Markel on the map and hit our vision.
Yes, because you can have as many slogans as you like on the wall, but you can actually see it. When it's working, you can see it.
You can see it and believe it. And actually, we went through a rebranding a couple of years ago. And one of the things that everyone can say is we are going to keep the Markel style. And it's embodied in 216 words. It was created back in the mid-80s as we went public. The team at the time, the management team, the Markels at the time wanted to say this is what we believe is true to us as a culture. And it's still very much true to us today as it was back in those 80s.
Well, Andrew, you're a man of great style. I already knew that. I've come to the end of all my questions, but is there anything we've missed?
No, I think we've covered quite a lot. I mean, what I would say is we've come on a great journey to date. So I think we've got a great vision as we put Markel on the map for the future. We have fantastic colleagues around the place, and we'll continue to attract and retain new colleagues and help us on our journey to be that global specialty player that we're wanting to be as putting Markel on the map for 2030.
Thank you so much, Andrew.
Thanks, Mark. Thanks for having me.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.